It's time for Your Personal Bank Show with Ference Toth, financial literacy educator and speaker, entrepreneur, and chairman of the board of Bank Information. Take charge of your financial future with Your Personal Bank. Now here's Ference Toth.
Welcome to the Your Personal Bank Show. We've got a lot of fun stuff to talk about today. I just want to touch on one thing. If you didn't hear the Tuesday show, I'm really going to encourage you to go to yourpersonalbank.com and check it out. I talk about a topic that I'm not going to touch on much today. I just don't want to waste a lot of time with it because I have some other great stuff to cover. But I talked a lot about annuities and particularly income annuities. I've been dealing with them for over 20 years. Been one of the top producers of that many of those years with some of the top companies. I, in fact, was on an advisory board, helped create some of these products with the chief actuaries and everything. Understand these products greatly. And the articles, again, they're on yourpersonalbank.com. You can check it out. Talk about how, well, annuities may have gotten a bad rap, but they really should be looked at these days, again, because of the low interest rate environment the Federal Reserve has put us in. And as they've stated, at least through the end of 2022, could be longer, we'll see. But that causes a real problem with returns, interest on bonds. So folks that are really looking to supplement retirement or income and things like that are struggling to find good returns. Annuities can be the solution to that, a guaranteed lifetime income annuity in particular. Again, when you say that word, a lot of people are, they lump them all together and they misunderstand what you're saying because there's so many different types. The key one I'm focused on here is the income annuity. It creates a guaranteed lifetime income. And like I said, what the articles talk about are instead of thinking of retirement as stocks and bonds, you really should start thinking about as retirement as stocks and annuities because they can accomplish that income goal that you have. So again, go to yourpersonalbank.com, check out Tuesday's show, more details on that, or contact us. We can show exactly how much you would get based on your contribution, your age, or when you start the income, comparing against a number of companies. You always want to do that to make sure you're getting the best rate if you're looking for guaranteed lifetime income. Okay? But what I really want to talk about today is, your personal bank topic. That's really the focus of our show. And again, Your Personal Bank really is simple. We're setting up a high cash value policy. It's not the type of policy most people are familiar with. It's to maximize cash growth, okay, on a tax favor basis. Then we integrate a bank line of credit. The collateral for the bank line is the cash. It's a collateralized loan, very low interest. In fact, we have dividends that are paying with companies right now 6% plus. They've paid that for the last 25 years in a row. Never miss a dividend since before the Civil War. Okay, folks, these are a long-term, A-plus rated, dividend-paying companies, many name brand. You know who they are. I'll show you a chart that'll compare all the different companies out there, all the big dividend-paying companies, and you'll see immediately. This is a chart, by the way, it was given to me by the lending industry. You will see immediately which companies are paying the best dividends and which company you want to work with and have paid it consistently over a long period of time. The bank line of credits, we can get as low as 3%. So it's a real simple question. I tell folks all the time, look, if you put your money into this, you're going to get credited 6% dividends if you leave it there. If you access it for whatever reason, you access it through the bank line of credit, it's still earning 6, the bank line's charging 3, what's your money doing? As soon as people understand that, it clicks in most cases. It's like, wait a minute, I can use and access, I leave my money where it is, that's fine, make 6%, insured, guaranteed, tax-free. I mean, that's what's going on right now. It grows tax deferred. You're not paying any tax on it. That's a pretty good rate these days, particularly these days. But if I want to access it or need to access it, for whatever reason, you can do so. And still make 3% on the money? Like bingo, you just got it. What does that do? Well, frankly, what it does is if you're let's say you're planning to finance something, purchase a car or something. Well, what you just did, or a house, anything else like that, you just reduced the borrowing cost by 3%, didn't you? Try that on a mortgage, a 30-year fixed mortgage. What kind of savings would you have? I have clients that are doing that, okay? In fact, that's some of what I want to talk about today is some of the situations where clients that I'm working with or have been working with many of them for many years, some decades even, how these tools are working for them and how they're using them. And that's one of them. I have a client recently who refinanced their house. They got 3.25, 30-year fixed. Pretty common these days. they had an account they weren't overly happy with. So they took the funds from that account, put it into a personal bank policy, which is paying actually right now 6.1% dividend. They have access to almost 90%. It's like 85-90% of the funds day one to pay bills and whatnot. Okay, for one thing they're doing, they have some credit card debt, double-digit interest. What did we do? We took some of those funds. I've done this with many people, by the way. Took some of those funds from the bank line of credit. Remember, they're earning 6.1, they're earning 6, getting charged 3. Access the funds, pay off the credit card bill. First thing, what happens? Well, the interest rate on the credit cards was like 15% plus. Well, when you pay off the credit card, you're not paying that interest anymore, are you? It's pretty obvious. Also, still earning 3% on the money. Why would they do it that way versus just taking the money and pay off the credit card? I get asked that question a lot. The answer really is quite simple. You see, if you take money and pay off a bill, or you can apply this to purchasing an item, what happens to those dollars when you pay that bill or purchase that item? And the answer is simple. You traded the dollar for the item, right? So if you bought a car, for example, folks that pay cash for cars, for example, whatever, or any item for that matter, you traded the dollar for the item. Or if you're paying off a bill, a debt, you got rid of the debt or reduced the debt, but you traded it for the dollar, right? Well, what happened there is you gave up control of that dollar, didn't you? When you pay off that item, or you pay off that debt, or you purchase that item, you just gave up control of that dollar, didn't you? You gave it up. You gave it to someone else. Will you earn interest on that money ever again the rest of your life? And the answer, of course, is no. This is a basic financial literacy concept that sadly is not taught very often. And it's a combination of control of your money and the time value of money. It's understanding those two concepts. Some people think paying cash for items is better than financing. Well, I would agree with that statement because you're not paying the extra interest. But the part they're missing is when you purchase that item, you give up control, don't you? That money can't earn for you in the future. So, for example, if you had a 5% car loan versus you paid cash for that money, what could that money made for you if you had not used it to buy the car? What interest rate, what return could you have gotten? And that's a lost opportunity cost or time value of money. So the point is, whether you finance or purchase, there's a cost, okay? What the personal bank does is it helps alleviate some of that cost. You can still purchase the items. You can still pay off the debt. In fact, we encourage folks to do that. But what you do is you reduce the cost of that debt by 3%. Or you still earn interest, earn 3% interest on the money if you use it to purchase an item. Well, that may not seem like a lot, but there's another key concept out there called compound interest we'll talk about further. What does 3% do over time? Decade, 2, 3, or longer. Now you can be talking about a significant amount of money. In fact, given enough time, the amount of money you use to purchase the item, the interest would come back. You'd be able to do it again. We'll talk about that further in the next segment, so stay tuned.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to Your Personal Bank Show. We've been talking about some number of financial literacy topics, time value of money, lost opportunity cost, compound interest. These are important things to understand because Your Personal Bank, the gist of it enhances all those different things. And we talked about in the last segment, again, if you missed it, I'm really going to encourage you. Go to yourpersonalbank.com. Check out any of the previously recorded shows, including this one. Check it out. Listen to it. Pass it on to others. There's a lot of financial literacy, a lot of education there, and better understanding money and your money in these shows. So And we've gotten lots of tremendous response from it, so I really, really appreciate it. Again, in the last segment, I was talking about how your personal bank could reduce the cost of borrowing, could allow you to earn interest on money you spent to purchase items, for example. But there's another tool, I see this used, another way to use it, I should say, I see commonly with clients, and that is to enhance investment returns. Now, this is where some people get a little confused. Maybe that's not the right word, but they don't follow completely because it kind of goes against what they've always known or been heard. Is how can you increase returns using an insurance product? Well, in and of itself, by itself, you're probably not, or a little bit. You might a little bit, but using the personal bank concept with the bank line of credit, combine the two together, now you can significantly increase returns. Here's what I mean. It's really quite simple. Remember, if you're earning 6 in your policy, that's the current dividend rates we have on companies that have been paying 25 years plus, never missed dividends since before the Civil War. Long-term, high dividend paying companies. If you're earning 6 on your money, you have access to the majority of it, 60 to 90% day one, depending on how we structure it. And you access it through the bank line of credit. Remember, you're earning 6, you get charged 3. What's your money doing? What's happening? Well, you're getting 3%. You're still making 3%. You took that money out, took that from the bank line, you're earning 6, getting charged 3. You're still getting 3% positive arbitrage is what the term is. Still earning 3% on the money. Now, what did you do with the money when you took it from the bank line? Really quite simple. What if you invested it in something, in an asset or an investment? And let's assume that investment or that asset averaged 7% return, for example. You could take your money, of course, and invest in that investment and make 7%, right? Of course, people doing that kind of stuff every day. But if you flow it through the personal bank, you could take funds from that and then invest in that same investment, that same asset, and now get 10. 7 from the investment, 3 from the positive arbitrage. So my question to folks is simple all the time. You're making 7. Would you like to make 10? Or you're making 10. Would you like to make 13? I mean, it's your money. That's what your personal bank does. Now, one of the common questions I get all the time is, okay, I like that idea. Of course, I want to make more return on my money and the positive arbitrage. By the way, folks, whenever you can generate positive arbitrage and you're doing it against a guaranteed asset that won't lose value, that's a strong thing to consider because you're going to make more money. You're picking up more dollars on your money. But the question is, okay, I do get it from the bank line of credit. I understand the cash in the policy is the collateral for the loan. So that's simple. It works, the principle works similar to HELOC, okay, home equity line of credit. There's no cost or fees for the loan, okay. Most people understand that kind of stuff. But don't I have to pay interest to the bank when I do the loan? And the answer is yes, of course you do. But remember, what's the interest rate being charged? If you have a $100,000 loan and you're getting charged 3%, that's $3,000 a year in interest, right? But if you have that same $100,000 in a policy earning 6, what's it earning? It's earning $6,000 and getting charged 3. Notice you picked up $3,000 difference. Positive arbitrage, right? Do you have to pay the $3,000? It's, by the way, it's usually charged quarterly. Do you have to pay the interest? Yes. Out of pocket? No. Notice you have several options. Could you pay it out of pocket? Of course you could. Now, if you're using that bank line of credit for business purpose, this is another benefit that comes into play. The interest can often be written off as a tax deduction. Okay? So in those situations, if somebody's using it for business purposes or investing, a lot of real estate investors use this. Folks that are, investors, entrepreneurs, various folks like that, it's a business-related purpose. I encourage them to pay it out, write a check, pay it out of pocket, because now they have a nice, clean expense for a tax deduction, don't they? Which means the 3% positive arbitrage, earning 6, getting charged 3, the 3% they earn, the gap became wider because now they get a tax deduction. Notice what they keep. The difference, the positive arbitrage, is even greater. I find it interesting. I have folks that are growing money on a tax-deferred basis in policies. We do this all the time. access the funds through a bank line of credit, use those funds for business purpose, and the interest becomes a deduction. It's pretty fun. All perfectly legal. There's nothing. We're not playing any games here. It's all valid with the tax codes and everything else. My point is, you can pick up that positive arbitrage. Now, what did you do with the money? Like I said earlier, if you're thinking about investing in assets, and by the way, what is the asset? That's entirely up to you. If you have an asset, you have an investment that you like, it's working, keep doing it. I'm going to encourage you to keep doing it, whatever it is. All I'm saying is add some positive arbitrage to it. Pick up 2 or 3% positive arbitrage in the process. So if you're, again, as I stated earlier, if you're making 7, do you want to make 10? If you're making 10, do you want to make 13? It doesn't really matter to me what the rate of return is on your investment or your asset. All we're doing is enhancing it, adding to it. It's like icing on the cake, right? There's some tax benefits involved. There's some guarantees involved. By the way, there is a death benefit. We're minimizing it, but that's the purpose. I mean, that's not the purpose, but that's one of the benefits. So if something happened prematurely, your loved ones would get a check. There's a living benefit. Basically, if you have critical, chronic, terminal illness type stuff, long-term care, it can help pay for those kinds of things, if not completely do so. Those are all built in. That's all part of the program. There's no additional charges for any of that. But the main purpose, the primary reason why most folks I work with do this is they want to take funds. They want their funds to work for them more efficiently. They want to make more. They want to get a greater return on their money than they're getting now. They want to enhance their returns. And again, it doesn't matter what they're invested in. We can add 2-3% returns to whatever it is you're doing. And that's how your personal bank tool works. Oh, and I forgot to mention the interest on the bank loan. That's where the common misconception or question comes. If it's used for business purpose and is a tax deduction for you, yes, pay it out of pocket because you got a nice clean expense and a nice clean tax deduction, which creates a bigger, wider gap. But if it's not that case, you could just apply it to your bank line. So your bank line would increase by that amount. But remember, the interest earning in the policy is greater. In this case, basically double. Your money's growing twice as fast as what you're getting charged. You're earning 6, you're getting charged 3. So if you did increase your bank line, for example, that year, we used an example, $100,000 at 3%. So you increase your bank line $3,000. The cash in your credit in your policy would go up $6,000. Okay. So what does that mean? You would have $3,000 more dollars, basically, right? That's what positive arbitrage is. This is how this tool works. And when you throw in compound interest, like I started to talk about in the last segment, that extra 3% over time compounding can turn into a significant amount of additional money in your pocket. Stay tuned in the next segment, and we'll talk about that a little bit more on how you can really enhance your financial future.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to Your Personal Bank Show. And we've been talking a lot today about, positive arbitrage. What does that mean? Well, we're talking about in the previous segments. It's really quite simple. With the personal bank concept, we're setting up a cash value policy that's paying 6% dividends. Currently has paid that rate or better last 25 years in a row. Never missed dividends since before the Civil War. These are, again, long-term dividend, A-plus rated companies with tremendous amount of cash reserves, well-positioned to continue to pay dividends into the foreseeable future, okay, and have for, like I said, 25 years plus. Then we set up a bank line of credit. Currently, we have rates as low as 3%. So if you're earning 6 and you're getting charged 3, what's your money doing? If you leave it there, you're going to get credited 6%, right? Like we've seen the last 25 years plus. If you access the funds to pay bills, purchase items, or invest in other assets, you're still picking up the difference, or 3%, aren't you? So what does that do for investments? Increases your rate of return by 3%. You making 7? You want to make 10? You making 10? You want to make 13? Those are the questions I ask people all the time. If you're borrowing money for mortgages, car loans, student loans, or any other business loans, any other type of loan, how would you like to reduce the interest rate on your loan by 3%? These days you can get a mortgage for around in the low 3%. I have folks that have set up mortgages, refied their properties, things like that, and are funding these personal bank policies using the dollars from the policy to make their mortgage payment. And basically what they're getting charged interest on their mortgage and what they're earning positive arbitrage is basically the same. So the net result is no interest. They got a no interest mortgage. You think that makes a financial difference in people's lives, especially long term? That's where compound interest comes in. I mean, even at a 3.25%, do you realize how much interest there's involved in a 30-year fixed mortgage, for example? A lot. Many of these cases, we're saving folks well over $100,000 of interest, sometimes much more than that. We're talking about hundreds of thousands of dollars difference in people's lives, in their pockets, over periods of a decade or 2 or 3, okay? That's the power of compound interest. That's the power of having the positive arbitrage and being able to still earn interest on monies that you're using elsewhere, allocating elsewhere for expenses, bills, debt, items, or investing. By not taking advantage of this, you're really doing yourself a disservice in terms of what you could do, what your money could do for you. You're not allocating your dollars in the most efficient way to grow your money as you could. And that's where I get into some of these articles, and I'm not even going to say who wrote this because these are so common, and it's frustrating. And this was in Business Insider, a well-known magazine and stuff, and you get these personal finance experts, quote, I'm going to say expert, quote unquote. I'm not going to say the name because I'm not going to get into a fight with somebody or embarrass anyone. But the title of this particular article I read this week was "Putting My Money in the Market is a Much Better Investment Than Whole Life Insurance, and Here's Why." And I hear this all the time. It's a hit piece. I'm sorry. And why somebody would attack, I talk about this all the time in terms of these financial tools are designed for specific purposes. I'm not saying this is for everyone, but what I am saying is it's definitely worth looking into. And what she doesn't talk about in this article at all, of course, is no understanding of the personal bank concept. In other words, no understanding of growing cash at 6% dividend long term, and no understanding of being able to access it at 3 to pick up 3% positive arbitrage. None of that is not a word about any of that is brought up in this article. And but makes these broad statements stating things like whole life insurance doesn't make sense for most people, and that's definitely true for me. It's far more expensive than term insurance and not the best investment vehicle. Well, for one thing, if you're comparing a 6%, let's take a whole life 6% return product versus a mutual fund or index fund or any other types of funds out there. Can the fund return greater returns than the 6%? Absolutely. There's no argument there. Okay. What's missing here is, well, that's not the only options as far as growing money in the insurance tool and the personal bank tool either. We have index options, which also not even discussed in this article, where you can be an S&P 500 index and earn anywhere. The floor is 1% and the cap is 14%. So basically each year you're going to earn between 1 and 14% each year. Your downside's protected. That's why the people do this. By the way, the last 25-year history, 8.52%. I can show you the brochure, show you the information. Now, 8.5% is not a bad return over the last 25 years. I think most people would agree, particularly when you consider the fact that you have no downside market risk. You have a 1% floor. You're going to make at least 1% each year. If you're going to compare strictly like this person is doing in this article, what's the maximum potential that something can earn? Well, okay, let's go there. Not talked about. What about the performance factor option? I've discussed this in previous shows. Go to yourpersonalbank.com. Check it out. You'll see a couple of shows where I talked about the performance factor. But in a nutshell, if you want to talk growth and put stack growth up, potential upside, head-to-head, great, let's do it. We have a performance factor option. Again, the principle is guaranteed. You will not lose on the down market. On an up market, you're going to get 2.7 times the performance, the index, which is typically S&P 500, and there's various other options, minus a fee, which all these products, all products have some kind of fee involved with them typically, right? So what's your return? Let's say the S&P does 10% gain in a particular year. What's your return? 2.7 or 27% minus a fee. Bottom line is simple. You're going to double what the index did. So she's talking about, well, if you do an index and these other things, great. There's nothing wrong with those. I'm not picking on those things. What I'm saying though is don't say it's not the best investment vehicle when you're not even willing to bring up these other options or these other tools or even compare them. It's like blinders. It's almost this article here, and sadly it's very common. It's somebody going through with pure blinders, talking about one tool and not really even comparing anything else out there, just saying this is the best one and other stuff's bad. I get frustrated when people just categorically discount products that have tremendous potential or use for many different situations. Like I said, the personal bank concept tool, we have the fixed steady Eddy 6% option. That's for the folks that want that consistent steady growth. We have the options for index where you can make 1 to 14% each year and has averaged 8.5 over the last 25 years. No downside market risk. That's pretty strong. And we have the performance factor option that can get you 2.7% time performance factor. In other words, the market does 10%, S&P does 10%, you get 27. We have those tools. By the way, all those tools can also be combined with the bank line of credit and allow you to access the funds in the 3% range. So if you had that index option where I mentioned 1 to 14% annual return, market goes down, you make 1%. Market goes up, you make up to 14. It's that simple. Some people try to make it more complicated. It's not. If somebody's trying to make something more complicated, it's because, one, they either don't understand it, usually, or typically they're a competitor. So they're trying to downplay it or discourage it. You know what I'm saying? If whatever you're investing in hasn't averaged 8.5% returns over the last 25 years, why wouldn't you look at a tool that has and does? I mean, let's be honest. Let's be real. Let's be a bit logical about it, right? Why not at least consider it? Oh, by the way, it also has no downside market risk. So if the markets are poor going forward, you're not going to lose. Oh, it has tax benefits. It grows tax deferred. Oh, we can access it through a bank line at 3%. So as long as it averages over 3, we're money ahead. And now the money, we can access it tax-free. And if we use that money for business purpose, we can get a tax deduction. Oh, don't forget there's the living, chronic, critical, long-term care benefit monies for that. And there's a death benefit that happens if somebody passes away prematurely. So do we want to compare returns? I think most people out there would consider 8.5% over a 25-year period a pretty darn good average rate. We can compare that head-to-head. Stay tuned in the last segment. We're going to talk a little bit more about this. And again, cutting through the noise and really looking at what's out there and why you should compare. Stay tuned.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to Your Personal Bank Show. We're rounding third, coming in home, and we've talked a lot about your personal bank and situations where it can really, really impact your financial future dramatically in the positive. Again, if you're looking at you have investments, assets. I mean, gosh, this is money radio. Most people that are listening to this either have investments or are interested in learning more about money and want to obtain some assets and investments. If you're going to do that, why not take a look at this tool that can create a 3% positive arbitrage, earn 6%, access it at 3%, and then take those money and invest in something. And in essence, basically, you're going to add 3% return to your money. Why not at least look into that? I mean, just makes logical sense, right? Secondly, what if you're going to use money, spend money? Gosh, we all spend money. We all have expenses. We all have bills. We all have things we purchase. If you can earn 3% on those expenses or on that debt or those purchases, why would you not consider looking into that? That's the thing that I find interesting. Of course, most people I talk to do, and once they do and understand how really simple it is and how it works, they start really, well, they move forward with it. I mean, that's just how I find things work, you know? And these articles, I touched on this. I don't like to badmouth other people, and I'm not going to say the name or anything, but I see these articles, and unfortunately, it's so common. You know, I could throw it in the hopper, and there'd be 100 of them like this, but it's talking about putting money in the market is way better than better investment than whole life insurance. And here's why. Well, if you're looking strictly at if you're looking at a product that can earn like a whole life product that's going to pay 6% dividends, has over the last 25 years, you're going to compare that to an index fund or something like that. Yes, there's no argument. The index fund is going to have greater returns most of the time. Okay, maybe not any particular 1 year, but over time, it's going to outperform. But what she doesn't mention in this article, and this is very common, guess what? There's index options where you can make 1 to 14%, where 8.5% is the average over the last 25 years. Okay, that's what it's done. So we can't say it's going to do that in the future, but if the S&P goes up, guess what's going to happen? It's going to make money. Okay, and if it goes down, you don't lose. That is not a bad thing. Oh, yeah, and you can access it, you know, in the 3s, bank line of credit. So if you're getting more than 3% return, you're picking up the positive arbitrage. Not a word of that in this article. And then we have the performance factor where it gets a 2.7 times of the market returns. And we can access, by the way, 10% return would be 27. Okay, so you could double the index, for example. Not uncommon in good market years. No downside risk. There's a fee, like there is with anything else. The reality is, you're really turbocharging your returns then, and you can still access the money in the 3s. So if you were making 10% or 20 or whatever it would be, think of the positive arbitrage there on your money. Tremendous. But, you know, the thing, like I said, about these articles, what I don't like is, you know, she talked to a friend and she was just shocked. She was stumped, as she said. Her friend is single, doesn't have kids, doesn't have a home. Why would she have insurance? Again, her parents purchased it for her. She liked it. You know, it's this single-minded blinder attitude that, well, gosh, if it's not if I think it's no good for me, it shouldn't be good for anyone else. Not true. Different risk tolerance, different goals, different situations. But I think what I find particularly frustrating is no concept or understanding of index products that can certainly get a bigger, higher return than a whole life contract. Whole life contracts can be in the 6% range, okay, past 25-year history. Index products, 8.5% range, past 25-year history. Performance products, well above that. None of that's discussed. Nothing about a bank line of credit, what we talk about in the personal line credit, personal bank concept, where you have a bank line of credit that's in the 3s. So if your return on your money is more than 3, you've got a positive arbitrage. Not a word about positive arbitrage, not a word about risk, not a word about future taxes, because these personal bank have tax benefits. What's the future tax rates going to be? One of my favorite books called The Power of Zero, written by David McKnight. You can check it out on Amazon or anywhere. And his basic concept is real simple. If tax rates double, but your tax rate on your investment is 0, 2 times 0 is still 0. So future tax consequences are not a factor anymore. None of that's discussed about this. It's just, well, it's not for me. It's not the best thing out there. It shouldn't be for you. And that's such a single-minded blinder attitude. I find it shocked that people are allowed to write these articles. and they're even considered advice, frankly. It's just such a narrow view of things and doesn't take into consideration so many different factors. I even hate to bring it up almost, but I only do that because you just see these things constantly. It's just like every week just about. There's another one, and it's just over and over again. Sometimes you just kind of get tired of seeing it and not saying anything. So my point is simple. If you're in a situation where you want to increase the return on your money, or you want to pay down some debt, or reduce the cost of financing, or reduce the cost of purchasing items, you should look into Your Personal Bank. It's that simple. We can show you how to set up a situation where your money grows. It's going to grow safely. You're going to have tax benefits. We can create positive arbitrage, at least 2-3% positive arbitrage, if not more, depending on which option we choose, whether it's the fixed, the index, or the performance factor. And here's the last thing I want you to understand. In our own industry, I get frustrated with that too. You have folks out there that are all about whole life and others that are all about IUL, Index Universal. And they rarely they all one or all the other. It's very common. And I challenge those insurance agents. And I say, look, everybody shouldn't have the whole life, the 6% steady Eddie. Everybody shouldn't have the index, the 1 to 14, the 8.5% average. In fact, some people should have some of both because diversification of returns is important too. Once I explain those kinds of things to the advisors, I rarely get any feedback. I almost invariably get 100% agreement. In other words, they got focused in their arena, just like this gal who wrote this article, and they get into their comfort zone, and they get comfortable with what they know and what they're familiar with, and they basically discount anything else out around them as an option. And I think that's a mistake. One of the things I share with people all the time is, and advisors when I'm educating and working with them, is this. Look, you're supposed to be advising people, giving recommendations, helping them guide them, helping them make good decisions about their future, their financial future, based on their situation, their goals, their needs. Folks, it's not about you and your personal preferences. This person that wrote this article doesn't understand that. If someone says to you, a friend, an advisor, or anybody else for that matter, that you should do this and not that, because that's bad, they're doing nothing more than sharing their personal bias. And now it's about them and not you. It should be, and it's supposed to be, about you. What's your goal? What you want to accomplish? What do you want to see your financial future look like? See, it's about you. And why I get excited about the personal bank concept is, in so many of those scenarios, again, not all, but in so many of them, it can enhance what you want to accomplish for your financial future. Stay tuned. The Your Personal Bank Show on 1510 AM or 105.3 FM. Contact us at yourpersonalbank.com for more information. Love to talk to you and share with you how this can make a difference for you.
Listen Tuesday at noon and Thursdays at 1 for more information on Your Personal Bank. Contact Ference at yourpersonalbank.com. This show is designed to provide accurate and authoritative information. The presenter and guest on this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Products and riders may have limitations and may not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage. Compare when considering a replacement. Dividend rates and baseline of credit rates may charge. Contact yourpersonalbank.com for current rates.